we've got some interesting economic developments that are part of the mix, and the Fed is trying to react to them. You wrote an issue brief this week, kind of looking at the Fed's dilemma here. And sometimes people look back to the 1970s and 80s, the last time we had high inflation, and said, are there any lessons to be learned here? What briefly did you find? So I guess there are always lessons to be learned. It's just like, what are they?
Well, people have been making the comparison that inflation is at a 40-year high. So we haven't seen, the last inflation numbers are basically comparable to what we saw in the late 1980s. And so, my intuition was to say, well, let's go back and look at what was going on in the 1980s and see whether there's anything we can learn and what that might tell us about what's going to happen from today going forward. And, it's obviously a bit of a gamble to say that, history will repeat itself. But if you start with the assumption that, it might repeat itself, and what would that look like? I took the data from the inflationary period, which basically starting in the mid 70s, the late 70s, and then the early 80s, we saw several sort of spikes and troughs of inflation, where inflation would go up and it would go down and it would go back up. And so throughout that period, the Federal Reserve was trying to contain inflation. And several times it made those efforts, and then it would back off. It would raise interest rates, and then inflation would come down, but then inflation would go back up. And so the Fed would have to raise interest rates again. So they went through several cycles of raising and lowering interest rates. And we're seeing some commentary in the press today where financial markets are saying, the Fed's got to fight inflation, but we expect them to be, they're going to get it contained by the end of the year. And we think interest rates will go back down by next year. And so, if you follow the historical pattern where the Fed, would raise rates and then lower rates, and, if we were to do that again, the question is, will we produce the same results as we saw last time, where essentially the Fed got behind the curve and they tried lowering rates, and they realized that inflation, in fact, was not contained, and they had to start all over and raise rates again. And so they went through that cycle several times. And so the question will be, whether we're going to see that kind of pattern going forward.
They've got, it seems like based on your modeling that the hard landing is going to be hard to stick. The soft landing is going to be hard to stick, because unemployment would have to go up to an extent that people just aren't anticipating right now.
Yeah, that's the dilemma. What the historical data show is that what really drives inflation down is either an increase in long-term interest rates or an increase in unemployment. And right now the Fed is saying, well, we're only going to raise, the Fed funds rate to about 3.8%, and we think unemployment's only going to be 3.9%. And so if you sort of plug those two Fed estimates or projections into the historical data, sort of trying to say, okay, how does this fit with this history? You see that the Fed does not even get close to its 2% inflation target. So either they're going to have to raise interest rates much higher, or unemployment rates are going to have to be much higher in order to see inflation get down to the 2% target that they've set for themselves. So, the question remains, which of those is going to give? The job numbers came out last Friday at 500,000 new jobs. And so, the economy appears to be chugging along. The labor markets are continuing to be tight. That doesn't indicate a recession. And so to get the unemployment rate up to fight inflation, interest rates are going to have to go up. And historically, they're going to have to go up much more than what the Fed currently is projecting they're at this point, they're committed to, or what they think they're going to commit to. So,
yeah, that's kind of the good news. And the bad news is the good news, the jobs number is fantastic and much more than people were expecting. And then, then you turn around and say, "Oh, well, I guess maybe the Fed is going to have to stamp, on the brake even harder and faster." And so the timing of we clearly don't seem to be in a recession now. The question is, oddly enough, does the strong job growth portend some sort of recession somewhere off in the future because things are running too hot.
I mean, I think that the message is that as long as the unemployment rate is as low as it is, you're not going to contain inflation, and interest rates are going to have to go higher. And at that point, when interest rates get high enough, inflation is going to start coming down. But the trade-off there is with higher interest rates, unemployment is also going to go up.
Well, the odd thing too is that wages, people are saying wages are growing too fast. Now everybody likes growing wages, but there's some concern.
Well, yeah, I mean, wages are going up, but they're not going up as fast as inflation.
No, they're not going up as fast as inflation.
Yeah, so workers are losing purchasing power because prices are rising faster than wages, but higher wages feed into inflation because, wages, the cost of labor is a major component of all the costs of goods and services. And so when wages rise, that also tends to push up prices. So yeah, it's a circular problem, and there's no easy solution.